Hello, good morning, candidates. This is for IBPS, PO, SBI PO, SBI Clerks, banking awareness. It is useful for all examinations. The number of questions they have been asking from banking awareness, it differs from exam to exam. Sometimes they used to ask 20%, 30% questions. But in some recent examinations, number of questions asked were less, 15% or so only. But however, we should be thorough with the banking awareness. Accordingly, I have been telling about various topics, and now I am on page number 62 of the booklet given by me. And the topic is financial markets in India and the instruments. This is the topic. First is about money market. Money market is a market for short-term debt securities such as commercial paper, repos, or certificate of deposit and treasury bills, where the maturity period is less than 1 year, 1 year or less. That is known as money market. Now, next one is capital market. Capital market is the market for long-term funds. It refers to all the facilities and institutional arrangements for borrowing and lending medium and long-term funds. After I will tell you in Hindi and also in Tamil if there is need be. Yeah. Now, money market versus capital markets differences. Money market is a market for short-term financial assets. Capital market is a market for long-term financial assets. Maturity for money market, maturity period less than 1 year, maturity period beyond 1 year. Money market deals over the counter. Capital market deals at stock exchange or through demat accounts. Money market number of players are limited. Capital market number of players is unlimited. Money market is regulated by RBI and the capital market is regulated by SEBI. What is SEBI? Securities Exchange Board of India. Where is its headquarters? Its headquarters is in Mumbai. Ajay Tyagi is the chairman of SEBI. SEBI takes care of stock exchanges, then mutual funds also. And for any initial public offering and all, they will have to get approval of SEBI. Incidentally, I read somewhere, some Equitas small finance bank, they were supposed to come out with issues, a capital issue, but they are now withdrawing from the scene because of the Corona crisis. Okay. Next one, major money market instruments. What are the major money market instruments? Certificate of deposit, then commercial paper, interbank participation certificate, interbank term money, treasury bills, bills rediscounting, and call money or notice money. These are money market instruments. These are money market instruments. Call and notice money also is included in this. For a non-commerce student, some of us may not be thorough with the terms. I'll just tell you, just listen. The terms relating to money market, call money means money lent or borrowed for 1 day. Then notice money means money lent for a period of 2 to 14 days. 2 to 14 days. Term money means money lent or borrowed for 15 days to 1 year. 15 days to 1 year. That is term money. Then yield to maturity. This type of instrument is expected rate of return on an existing security purchased in the market. Then coupon rate, specified interest rate on a fixed maturity security fixed at the time of issue. That is known as coupon rate. Then let us see about call or notice money market operations. Under call money market, funds are transacted on overnight basis, and under notice money market for 2 days to 14 days. Participants include banks, excluding RRBs, and primary dealers, both as borrowers and lenders. Non-bank institutions are not permitted in the call or notice money market. Then calculation of interest payable is based on FIMMDAs, that is Fixed Income Money Market and Derivatives Association of India, Handbook of Market Practices. So this is about call money market or notice money market. Then instrument of government borrowing to meet the temporary receipt and expenditure mismatch. Government obtains overdraft from RBI under ways and means advances. For short-term liquidity, it issues cash management bills, Treasury bills of 91 days, 182 days, and 364 days maturity. For long-term funds, it uses dated securities in the form of bonds and long-term loans. Bonds and long-term loans. Next is Treasury bills. These are the instruments within bracket in the form of promissory notes of short-term borrowing by the central government, first issued in India in 1917. Investors, Treasury bills can be purchased by anyone, including individuals, except state government. Denomination, minimum amount of face value rupees 25,000 and in multiples thereof. There is no specific amount or limit on the extent to which 364 days. Rate of interest, Treasury bills are zero coupon securities. They are issued at a discount and redeemed at face value at maturity. The return to the investors is the difference between maturity value or the face value and the issue price. The face value may be 100, the issue price may be 95. Then 5 rupees is the interest they get. Next, cash management bills. CMB was introduced in 2011, is a short-term security to be sold by Government of India to raise temporary money for cash management needs. The tenure is less than 91 days, but the notified amount and date of issue depends upon the temporary cash requirements of the government. It is issued at discount to the face value through auctions. Next, dated securities. These are long-term securities and carry a fixed or floating coupon interest rate paid on the face value payable at fixed time periods. The tenor of dated securities can be up to 40 years. Public Debt Office of RBI acts as the registry or depository of government securities and deals with the issue, interest payment and repayment of principal at maturity. Ways and means advances were introduced as per an agreement between RBI and government. WMAs are temporary overdrafts by RBI to government. What is the objective? They bridge the time interval or mismatch between expenditure and receipts. These are not a source of finance. Duration 10 consecutive working days for central government, 14 days for state government. Next is certificate of deposit. This scheme was introduced in July 89 to enable banking system to mobilize bulk deposits from the market, which they can attract at competitive rates of interest. That is, the rate of interest allowed on certificate of deposit is higher than except RRBs and all India financial institutions within their umbrella limit. CRR, SLR, companies, trusts, funds, or association. Maturity minimum 7 days, maximum 12 months. In the case of financial institutions, minimum 1 year, maximum 3 years. Amount minimum rupees 1 lakh, beyond which is multiples of rupees 1 lakh. Interest rate, market related, fixed or floating. Loan against collateral of CD, not permitted. Nature, it is a usance promissory note, that is number of days, can be issued in dematerialization form, only effective from June 30, 2002. Commercial paper. Commercial paper is introduced during 1990, is a short-term money market instrument issued as an unsecured usance promissory note or privately placed. Who can issue commercial paper? Companies, primary dealers, and all India financial institutions. Maturity minimum 7 days, maximum of 1 year. Amount in the case of commercial paper, minimum rupees 5 lakh, multiples thereof. A company is eligible to issue commercial paper if its tangible net worth is not less than 4 crore. Sanctioned working capital limit by bank or financial institution. Borrower accounts are classified as standard asset by financing bank. Minimum credit rating from SEBI approved credit rating agency is A3. Rating should not be due for review. So these are the points regarding commercial paper. These are the points regarding commercial paper. Yeah, 1 minute. Yeah, I think I can continue for some more time and tell you some more points also. Next is, what is merchant banking? This type of questions are asked in interviews. What is merchant banking? Merchant banking stands for providing various services relation to capital market and financing the corporate sector. The merchant bankers provide consultancy to the corporate sector on the issues like finance, capital structure and investment, mergers, takeover and amalgamations, establishing coordination between the government and the corporate sector. Next comes capital markets in India. Capital markets in India. It refers to all the facilities and institutional arrangements for borrowing and lending medium and long-term funds. It is segregated into government and semi-government securities, which are traded in the market in stable value and are sought after by banks and other institutions. The industrial securities market refers to the market for shares and debentures of old as well as new companies. The primary market refers to the setup which helps the industry raise funds by issuing different types of securities. The secondary market refers to the network for subsequent sale and purchase of securities after these are issued. See, initial public offer is known as primary market. Thereafter, now when they are sold and bought, that is known as secondary market. A brief on Indian depository receipts. IDR is an instrument in the form of a depository receipt created by an Indian depository in India against the underlying equity shares of the issuing company. In an IDR, foreign companies would issue shares to an Indian companies would issue shares to an Indian depository, which would in turn issue depository receipts to the investors in India. This is there on page number 67. Now 68, mutual fund terms. Asset management company, a company formed and registered under the Companies Act 1956, approved as such by the SEBI to manage the funds of a mutual fund. Under an agreement, an AMC undertakes to formulated mutual fund schemes, distribute income as per agreement. What is a balanced fund? This fund invests in bonds and blue chip stocks to conserve capital. It pays reasonable income, capital appreciation. Close-ended scheme, a scheme where funds are raised for a fixed period. The scheme is wound up after that period and funds are returned with capital appreciation to unit holders. Normally, a close-ended scheme is listed on a stock exchange. Fixed income funds, a mutual fund which primarily invests in fixed income securities like bonds and debentures. Objective is to provide monthly or yearly income to investors. What is net asset value? The price of value of one share of a fund. It is calculated by summing up the quoted values of all the securities held by the fund, adding in cash and any accrued income, and subtracting liabilities and dividing the result by the number of shares outstanding. Fund companies compute the net asset value once a day based on closing market prices. The last one, open-ended scheme. A scheme is the one which continuously offers its units and buys them back from investors. That means the mutual fund will be going on selling and buying it from the people. That is known as open-ended scheme. So these are some of the points. So far we have covered up to page number 68. So thank you so much. So we have covered topic number 17. Then some more topics are there. I think total number of pages for this booklet is around how many pages? Now we are on 68. Another 60 pages may be there. Maybe we can complete it in 10 days or so. So that afterwards, this will be a complete book for you. Banking awareness. Anytime you can listen to that. Thank you. Best wishes.